Hello and welcome to this explainer. Today, we are diving into a really fascinating intersection of ancient ethics and modern finance. We're going to unpack exactly how Islamic jurisprudence tackles a very modern, everyday necessity, and that is risk management. Now, I know it sounds like a complex, highly regulated world, and, well, it is, but we are going to break it down clearly, thoroughly, and see how these systems actually work under the hood.
So let me ask you something right off the bat. Is your insurance policy actually a gamble? It's a pretty provocative thought, isn't it? I mean, we usually think of insurance as the exact opposite of gambling. It's supposed to be our safety net. But when you really stop and look at how conventional insurance is structured, you're essentially paying for an entirely unknown outcome. You might pay premiums for decades and get absolutely nothing back, or you might pay once and get a massive payout. As we'll see today, from a classical Islamic legal perspective, this structural uncertainty presents a really massive theological problem.
Here's our roadmap for today. We're going to cover the commercial insurance problem, the triad of prohibitions, the rule of necessity, takaful as the cooperative solution, the actual takaful business models, and we'll finish up with a head-to-head comparison of conventional versus takaful insurance. Let's jump in.
Section 1. The commercial insurance problem. The clash between modern security and classical law.
Okay, so in Islamic jurisprudence, a conventional insurance policy is classified as an exchange contract. In Arabic, that's known as uqud al-muwadha. Think of it like a really simple transaction. Buying an apple. You hand over $1 and you get the apple. For an exchange contract to be valid and ethically sound in Islamic law, both parties literally have to know exactly what is being traded at the exact time of signing. You pay a specific price for a specific good. But commercial insurance, it fundamentally violates this rule. Neither the insurer nor you, the insured, can actually identify what you'll give or take when you sign that paperwork.
Moving to Section 2, the triad of prohibitions, and exactly why the majority consensus prohibits commercial insurance.
There are three specific Arabic terms that make up what we call the triad of prohibitions. They are gharar, mazer, and riba. Basically, if a financial contract contains these elements, it's generally considered invalid under Sharia law. Let's break these down one by one, because it's absolutely crucial to understand the actual mechanics at play here.
First up is gharar. This translates to excessive uncertainty. Imagine you're paying for a mystery subscription box, but you don't even know if the box will ever arrive, or if it'll have a diamond inside, or just an empty wrapper. That is essentially auto insurance. You might pay for 2 decades without ever getting into a single accident, so you've paid thousands of dollars but received no tangible financial countervalue. Or, on the flip side, you pay 1 month's premium, total your car the very next day, and receive a payout worth 40 times what you paid. Because the compensation depends entirely on an unknown future risk, it creates this speculative dependency that classical scholars explicitly forbid.
Now that structural uncertainty leads us directly into miser, which means gambling. I know, buying car insurance doesn't exactly feel like a wild night out at a casino, but structurally, it creates a scenario of chance where one party wins at the direct financial expense of the other. Think about it. If the risk never occurs, the insurance company keeps all your premiums as pure profit, and you lose your wealth with zero return. If the risk does occur, you win a massive payout and the company takes a huge financial hit. It is, by definition, a zero-sum game of chance.
Finally, we have riba, or usury. And it's really important to understand that this is triggered in 2 distinct ways within commercial insurance. First, the core transaction itself involves exchanging cash, your premiums, for deferred cash, your eventual claims payout. Because these amounts are almost never equal, it triggers usury of excess and usury of delay. But secondly, and honestly on a much larger scale, conventional insurance companies take that massive pool of premiums they collect and just dump them into interest-bearing assets, like conventional bonds. This back-end practice completely compounds the usurious nature of their operations from an Islamic perspective.
And, as we see in formal legal rulings known as fatwas, modern scholars haven't just, rejected modern finance out of hand. Not at all. They've actually rigorously synthesized classical contract law to evaluate commercial insurance step by step. They look at the text, they apply the principles of gharar, mazer, and riba that we just talked about, and they arrive at a very logical structural conclusion.
Section 3. The rule of necessity, the exception for mandatory coverage. Now, this raises a super practical question. What exactly happens when a Muslim lives in a country where auto insurance or health insurance is legally required by the state?
The answer here lies in the principle of darura, which translates to the rule of necessity.
Islamic jurisprudence is actually highly pragmatic. Scholars fully permit participation in mandatory commercial insurance if it's to prevent legal or financial ruin. I mean, you need to drive to work, right? And driving without insurance is illegal. However, this is strictly an exception. The rule dictates that you must only purchase the bare minimum mandatory coverage required by law. And here's an interesting caveat. If you ever receive a payout that actually exceeds what you paid in premiums, many scholars advise directing that excess, ill-gotten wealth straight to public charity. You simply cannot profit from the necessity.
All right, moving on to Section 4, Takaful, the cooperative solution. So how did the Islamic finance industry actually engineer a structural workaround to this massive problem?
Well, the foundation shifts entirely to something called tabaru. This is a cooperative donation. Instead of buying your risk away from a massive corporation, imagine just passing a hat around your community to create a mutual safety net. The participants mutually agree to bear one another's risks. Because the money is given as a voluntary donation rather than a strict commercial trade, those problematic elements we talked about, the excessive uncertainty of gharar and the gambling aspect of maisir, they are completely neutralized. You aren't gambling, you're donating to a community fund that's there to help you if you ever need it. It's a brilliant shift in perspective.
And to make sure this isn't just, a clever marketing gimmick, global standard-setting bodies like AAOFI step in. That's the accounting and auditing organization for Islamic financial institutions. They provide incredibly rigorous global standards to ensure these cooperative funds remain transparent, strictly separated from the operator's own money, and 100% Sharia compliant.
Section 5. Exploring Takaful Business Models. Let's look at how Islamic insurance operators actually function in the real world.
So the golden rule here is that operators absolutely cannot treat the premium pool as their own money. So how do they keep the lights on and get paid? Well, under the Mudaraba model, the operator acts as an investment partner. They take a pre-agreed profit share solely from the returns they generate by investing the pool, not from the premiums themselves. Then there's the Wakala model. Here, there's simply an administrative agent charging a flat, transparent, pre-agreed fee for doing the paperwork. And finally, in the Waqf model, the initial fund is set up as a permanent legal endowment and the operator just takes a trustee fee. In all of these models, the operator makes a legitimate, ethical income for their services, but the actual risk pool strictly remains the property of the participants.
Section 6, Conventional versus Takaful Insurance, the bottom line. Let's wrap this explainer up by directly anchoring these new concepts against the conventional model we're all used to.
Structurally, the core difference really comes down to how we handle risk. In conventional insurance, you have risk transfer. You pay a premium to transfer your personal risk to a massive corporation. But in Takaful insurance, you have risk sharing. The risk is shared horizontally among a community of participants who have literally formed a mutual agreement to support one another.
Next up is capital ownership. In the conventional system, the exact second you pay your premium, that money becomes the legal property of the insurance company. It's their revenue now. In Takaful, the tabaru, those donation funds, are strictly separated from the operator's shareholder funds. The operator is merely managing the pool. And honestly, here is the absolute best part. If there is money left over at the end of the year after all the claims are paid out, that surplus actually belongs to you, the participants, not the company. Finally, let's talk about the investment strategy. Conventional insurers rely heavily on unrestricted, interest-bearing investments, like corporate and government bonds, to grow their massive reserves. And as we know, that triggers riba. Takaful strictly avoids this. The communal pool can only be invested in Sharia-compliant instruments. We're talking about things like sukuk, which are Islamic investment certificates, or in the halal real economic sector. That means investing in tangible, real-world assets like real estate or infrastructure, rather than just trading paper debt. This ensures the entire life cycle of your money remains ethically untainted by usury.
And that brings us to a final thought I want to leave you with today. How will you balance financial security with your ethical principles? What we've really seen throughout this explainer is that the structural design of our financial tools isn't just about math or risk curves. It's a direct reflection of much deeper societal values. It's the choice between individualistic risk transfer and cooperative, community-based risk sharing. Thank you so much for joining me today. I really hope this sparked your curiosity, and I highly encourage you to keep exploring the incredibly fascinating world of Islamic finance.